Hi everyone, this is Demel Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook video. So the big question that I've had a lot of people ask me about, and I see it all over the media, is what is going on with Powell and Trump? There seems like there's a big tug of war going on right now between Trump and Powell and lowering interest rates, and we don't want to lower interest rates. And so Trump's trying to get mortgage rates to come down to kind of help with the housing market because that hasn't been really good right now. And is lowering the Fed funds rate going to actually help the mortgage market or not? And I'll also get into what I think is going to happen. Okay, so we'll get into that and a lot more because there's a lot going on in the economy and the markets. So let's get started. All right, let's get started with the asset class returns for the month of July. So the theme for July was kind of a comeback story for the U.S. markets. You can see right here the S&P 500, large cap domestic stocks, led the way up 2.24%, a pretty good return for the month. Even the small caps were up a little bit. Real estate was flat. Developed international was flat. Even though we had that big trade deal with the EU, it was still kind of flat for the whole month. A lot of that has to do with the fact that the dollar actually has made a little comeback here, got back up to more of an average range within the last month. Emerging markets, though, regardless of the dollar being a little stronger, still had a decent month. We're starting to see maybe a little bit more activity from China. So that helped emerging markets. Fixed income markets were flat. Interest rates were kind of flat to slightly up a little bit, so it didn't really make too much of a factor. They've been doing okay for the year. High yield, kind of same story with just a little bit more drama. And then, of course, commodities. Gold is the big one here. Gold has been doing pretty good. That's why you see a nice return year to date. But it was down a little bit for the month. And commodities in general have actually done a little bit better. Natural gas and some of these energy stocks, or commodities I should say, have gone up a little bit for the month. So you can see that it was basically kind of a little reversal of everything that's been going on the last 2 or 3 months. All right, let's take a look at how the economy's been doing fundamentally. So we take a look at the Big Three report where we look at the ISM numbers and we look at what's going on with employment. And so the ISM PMI, that's the manufacturing one. This one was actually down a little bit previous to last month, from a 49 to a 48. And remember, anything under 50 shows that things are contracting a little bit. The manufacturing number has actually been below 50 for quite a while, so it's not a huge concern yet. But when you start getting the manufacturing and the services number below 50 for a few months, that is a precursor to things really slowing down, maybe a recession coming. So that's why I like to keep an eye on these. You can see the non-manufacturing number. Actually, that number just came out this morning, so I'm recording this on Tuesday. It was a 50.1, which is also down a little bit from 50.8 previous. Now, it's still above 50, so it's still positive. That means it's still growing. It's just growing slower. So that is a little bit of a concern, but not anything to really jump ship about quite yet. Now, the big ruckus that happened last week on Friday was the BLS employment report. It's probably been on the news for a lot of other reasons as well, with Trump talking about firing the chief person there and everything. Another conversation. You can call me. We can talk about it. But anyways, the report showed 73,000 new jobs, which is a decent showing. It was a little bit below expectations of about 100, but still decent. And the unemployment number ticked up a little bit from 4.1 to 4.2. Not a big deal. Again, kind of showing a little softness in the employment data, but still pretty decent. Now, I say the ruckus because there is a huge revision that happened also this month. what the BLS does is they, since they get all this data and they have to update it constantly because not everybody responds to the little surveys and things, so they update these numbers, and you can see May and June there were these really big revisions. So let's talk about that in the next. The next slide. I got a little chart to show you. All right, so here you can see the big revision that happened for the month of June and May. It was actually a very big revision, down 258,000 jobs. So we went from averaging 144, 149 to like 19 and 14. Yikes. So that basically just goes to show you that it looked like the labor market was hanging in there pretty good, but it really wasn't. It was actually kind of struggling here in the last two. If you include this month, maybe not quite as bad, but at least for those prior 2 months of May and June, things really weren't looking that great. And so we'll have to see what happens in July here, see if there's a big revision there too. It does seem to jive a little bit with what the ADP report, which is another source for employment data, which is actually getting direct feed from ADP, the payroll company. And so you can see that the payroll numbers from ADP were down dramatically for May and June, but actually came back up for July. So hopefully that July number will not have as big of a revision, and it could even have a revision up. We'll have to see. So I don't think that this is kind of an ominous trend that's coming. At least it doesn't appear to be just yet. It really looks more like the last two previous months weren't as good as we thought, but things are maybe starting to kind of come back a little bit. All right, the other big piece of news we had the Fed meeting. So there's been a lot of drama about the Fed here recently. We're going to get a little bit more into that in the outlook. But they met and they made no changes to the Fed funds rate. And in fact, now that we have this information from what happened on Friday, I'm wondering if the Fed would actually maybe think differently or do something differently than they did, because they made no changes. And now when we look at the probabilities for a cut on the next meeting, which is September 17th, we can see that 25 basis points, that's 0.25%, is got an 82+% probability. And in fact, I think when I created this little graphic, it's gone up even more from that, since we got a little bit more information from that services PMI. And so the probability of some rate cuts coming are looking really, really good. In fact, there's another potential cut before the end of the year, and some even think there could be a third. Not sure about that, but the probabilities are starting to go up. All right, and then the last piece for the update is inflation. What's going on there? We have the PCE inflation number that just came out last week. And the favorite number for the Fed is this PCE core. They look at that one because that takes out energy and food and all those volatile things, which were up a little bit for the month. You've probably seen what's going on with Iran and Russia, some things ratcheting up. So that made energy prices go up a little bit. But still, the core was up 0.3% month over month. So think about that. Annualize that out, the 3.6. That's not great. And the year over year is 2.8. So it looks like inflation is kind of sticking around. So you can kind of understand why the Fed's been hesitant to cut rates, because they see this, and then of course they're concerned that the tariffs can start feeding into inflation. It hasn't really shown its ugly head as bad as they thought, so I think that's why they're probably starting to turn the corner with cutting rates in September. But that hesitation seems to be valid based on what you're seeing here. But again, that's a whole long conversation that we can have off video here, if you like, at some point. But the inflation number is sticking around, and so that's important for us to kind of keep an eye on. right, so let's dive into the question that I teased at the beginning of the video about the Fed lowering rates. Is it going to help the mortgage market and the housing market? Well, you're going to see that the answer basically depends. And I want to show you kind of how this looks like, because this isn't really talked about very much in the media. First of all, you have to understand that the 30-year, now we're just talking about the 30-year fixed mortgage, is mostly correlated with the 10-year Treasury bond. And it kind of makes sense, you know, a longer-term investment. It's a longer-term bond, so it's going to correlate more with that. And the Fed doesn't really have direct control to the 10-year Treasury market, okay? When they talk about raising rates or lowering rates, they're not talking about raising the 10-year or lowering the 10-year. They're talking about a rate called the Fed funds rate and the discount rates. Those are all very, very short-term rates, and they do have, you know, their little tentacles that get out into the rest of the market, but it's not directly correlated always, okay? And so they're talking about these little short-term rates that banks use to lend to each other and all this stuff. It affects money markets, and it could affect credit card rates because some of those are based on those shorter-term rates. But on the longer-term rates like mortgages, it's the 10-year. So let's get into a little bit more about what affects the 10-year rate. All right, so here are the two charts that really get into the nitty-gritty here. So hang in here with me, because after I'm done here, you're going to have a big light bulb moment just like I did when I really dug into this. All right, so what has happened to the 10-year? This is what we're showing you on this chart right here. When the Fed has cut rates in the past, like the first 100 basis points, that's 1%. You could see that in the past, a lot of times it's gone down a little bit. A couple times it's even gone up a tiny bit. And the last time, back in September when they started cutting rates, look at this. The 10-year Treasury actually went up. What the heck? Okay? So, ironically, when Trump is, browbeating Powell to cut rates, again, Fed funds rate, it may not even accomplish what he wants, because if the same thing happens as last time, it could be that rates actually go up. So what is making those rates go up? I just talked about how the Fed funds is not really that correlated. So what is more correlated? Well, that's what this chart shows here on the right. Okay, the drivers of rates. The number one driver, as you can see here, is the big dark blue, and that's growth expectations. That is the biggest contributor to what's going on with interest rates. So if interest rates are going up, that means that the growth of the economy is probably going up as well. So when the Fed was cutting rates recently, it was actually for a good reason. Inflation was starting to come down. Unemployment kind of crept up a little bit back in September. That was their excuse for doing it, but it still wasn't very bad. It was actually still pretty low. And so the market saw that as a green light for a good economy. And then on top of that, we saw what happened in November, and the market was a little excited for maybe a Trump presidency and some of the potential pro-growth policies. So that all made the 10-year go up. So you can see that that's a biggest component. Now, there is some uncertainty, and there's a lot of uncertainty that can make the rate go up a little bit as well, and you can include a little bit of that potentially in as well. But those are the biggest pieces. So what is happening right now? Okay, you saw the inflation number is still kind of sticky. Growth is starting to slow down a little bit. So why would the Fed cut? Well, the Fed will cut if they see that inflation's benign, which is still a little bit of a question mark, but for the most part it is. And then so that actually could be cutting for a good reason. And if they cut for a good reason, which is kind of what Trump wants, because he wants employment to be strong and inflation to stay flat. He wants the Fed to cut rates for the good reason. That's actually going to increase growth, which is going to potentially make the rates not go down, maybe even stay the same or go up. The reason there is a correlation with the Fed cutting rates and the rates going down is because usually the Fed is cutting rates because things are getting bad. Things are getting bad in the economy. So they're trying to save the economy from getting down too far into the doldrums. So that's why there's a correlation in the past with the 10-year going down when the Fed cuts. But it's actually not a direct correlation. It just so happened to work that way a lot of times, but it doesn't always work that way. So you can see that what I think is going to probably happen is the Fed is going to cut rates because they're starting to get a little nervous about jobs. Inflation doesn't seem too bad. This is kind of like a repeat of what happened back in September. So I don't think the 10-year is going to go down. I think it's going to kind of stay at this level. I don't think it's going to go up a lot more, but it's going to probably stay at this level, which is right around 4 to 4.5%. So that's not going to be a big boost for real estate and the mortgages, unfortunately. But it will potentially be good for the stock market because the economy will get a little, tailwind from lower interest rates. So let's boil all this down to what really matters is how is this going to affect you? And how are we changing the portfolio to reflect this? And so, as you can see, I'm thinking that the Fed is going to be lowering rates, but it's probably not going to make the longer term and intermediate term bonds rates go down very much. So it's not really a great time to be owning long-term bonds, especially as we keep spending, more than we have coming in, although maybe that's getting a little better, but the trend is not our friend there. And so I'm going to be reducing long-term bonds and adding floating rate bonds. They have a nicer yield and they're more economically sensitive. I don't feel like we're going into a recession. I think the economy seems to be holding up pretty good, even though there's a little bit of a scare right now, which is actually the best time to be making that trade. I'm also not ready to jump into the everything is all clear and let's just load up on mid cap and small caps. So we're still going to be sticking with the large cap, more income oriented, a little bit less volatile type of stocks. And we're really not making any changes with the other, which is really the gold versus the commodity trade. We're sticking to gold for a little bit longer here. Although I think if the economy does start to come back, because maybe rates are starting to come down, I'll probably be making that change here in the coming months. But not yet. So overall, we're still pretty neutral. Some positive signs with the job numbers, I think, although the market perception is that it's bad, so it's a good opportunity to actually take advantage of some dips as they come, because I don't think we're going into a major slowdown. This is just more of a little bump in the road. And so I hope this helps, guys. I hope you enjoyed the video. Please feel free to share this video with your friends and family. But thanks for watching, and God bless. Bye-bye.